Today is Tuesday, the 7th of April 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, I said that a company can get bigger and weaker at the same time. And you say, well, how that come? Well, watch yesterday's chapter. Now, today I want to take to next step, right? So I'm going to pull the graph in front of us. So we have the reference point, the visual cue, as they say. And this is a full advisory board operating system because the companies have this idea that actually they have to address things linearly, right? Linear is one thing at a time. But what happened in reality is that everything happened at the same time every single day at the same time, right? So you have your brand that is operating every single day at the same time as your teams are working, or your partnerships, your governance, risk and compliance, etc., etc., etc. So now, we spoke yesterday about scaling. Today we're going to talk about growth, capital, and predictability, which is this section here on the right? Okay, so now that we have the visual cue, and particularly I want to talk about predictability because this is where many classic boards, executive teams, and founders get caught. They go looking for capital before they have built the confidence, right? So they present ambition, or they present ambition before they present control. And this, or they ask investors to believe in the future, even as the present remains a bit fuzzy, if you may. So that is very expensive because you invest a lot of time and effort uh, connecting with people, etc., etc. But you get a no as an answer, and you don't understand what is going on. Why I'm not funded, or the investors are not like. It's not that they don't like you. It's not that they don't believe what you believe. Is that actually the future doesn't seem very, very clear for them. And then we are not helping them to help us, if you may, right? And this is where I come in as a board advisor. I build rotating international advisory boards around the milestones in front of your company. So you get the specialist capability you need in a fraction of the time it takes to hire one executive, without the big consulting overhead, without the talent locked in, and with the members changing as the project evolves. Because remember, once you get the funding, what you want to do next also is part of your credibility and your predictability. So you might have a specialist in these areas of preparing the company for funding, but then you need another set of teams actually to go operational and execute and do the things that they need to do to get that funding to produce the results that you committed to your investors. Now, let's take a look at three problems with this. And I'm going to say something before I start with the problems. I use a lot of statistics, guidance, frameworks, etc., from the UK and public listed companies. Why? Because the business principles are pretty much the same. So if you go into any jurisdiction in the world, any business vertical, etc., the business principles are pretty much the same. So it's not something that you say, well, that doesn't apply to me. And we covered this, it doesn't apply to me many, many times. It does apply to you because actually, when the large organizations in the world have their compliance requirements and the auditing requirements, etc., guess where they cascade that requirements to their suppliers, customers, investors, etc. They cascade that, and you perhaps don't realize that. And a perfect example is in distribution channels or logistics, when the companies have to produce this report about carbon emissions, equal payment, diversity, etc., etc. That's not your requirement if you are not in that scope or that requirement in terms of the materiality analysis that you have to do in your company or not. But probably your suppliers, you're supplying to a company that is mandatory for them. It's not even voluntary, it's mandatory for them. And part of their mandate is to make sure that their supply chain is compliant with the things that they are claiming, right? So you say, well, it doesn't affect me because I'm doing business nationally or locally, etc., etc. Just look again to your contracts, look again to your tenders. When you're tendering to gain a contract or a business, etc., etc., what are the requirements of the other companies? And you will start to see that these things that seems to be so far away from you actually really apply to you, even if you don't realize that are applying to you. So keep an eye on these kind of things, and that's why I'm using these public, very public examples, because if you learn this principle, or you at least have an awareness of these principles, then you can start to look into your business and say, aha. And one aha moment can make a whole difference for the year or perhaps the lifespan of your organization. Now, let's look at three problems then. Number one is the market is still selective, right? So I get this from the British Business Bank that says a high cost of credit and risk aversion remain key reasons behind weak investment. And this is in the 2025 equity tracker says the deal volumes in Q3 24 and Q1 25 were at their lowest point over the past decade, right? That means that the weak capital story gets punished fast. And what I mean is, actually, remember what I said yesterday and last week. The British Bank also reported that actually their loan capacity was £2 billion, and they loaned that money actually, but to less companies. This is where the problem is. The market is still selective and start to get very, very, very more selective as the time passes by. And this is because the stories now, they doesn't require a good narrative, a good vision of the future. They are looking for predictability. How strong is your business, not today and yesterday, in the next decade, perhaps. Well, not decade is too much, but actually is how predictable are the things that brought you to today and will continue tomorrow, right? So this is a problem. The second problem is this access to money does not mean comfort, right? So even if you have that capacity. So the Bank of England again reported that overall credit availability to the corporate sector increased only slightly in Q1 25, with the availability for large businesses unchanged. That is not a market shouting, yes, we have money. That is a market asking better question, right? So back to the example of the 2 billion. So what he's saying here that it is not that it is a lack of capital, it's a lack of trust in the predictability of the businesses that ask for that capital. As if you're looking for investor, a round of funding, or a loan, a credit loan, whatever, or a line of credit, whatever is the case. Look at how predictable your business is to say it for the capital or the institution to say, well, yeah, we are interested, because actually that makes a lot of sense, and actually we can see the path very clearly. And the third problem is the finance people in the room are still cautious, right? Actually, your own teams are very cautious about this request. And why? Because it's supposed to be the people that are helping you to gain the confidence to go to the investors, institutions, and ask for more funding. So Deloitte's Q4 2025 CFO surveys say the corporate risk appetite had aged up, but remained well below average. So what that means, that 38% of CFOs still rated external uncertainty as high or very high, meaning that actually external uncertainties are the major reason why they are not going more active into looking for capital. So if you, as a board, as executive team, or as a founder, still telling a growth story without a predictable operating story underneath, the people who signs checks will feel the wobble, right? So if your teams are saying, oh, well, external uncertainty is high or very high, so I will wonder why you are depending exclusively on external certainties to look for capital. That means actually where you say, look, I'm operating in an environment where all the external things are very uncertain. So we don't have really a good position to ask for capital. So that means that you are not in the responding to the environment situation. You are reacting. So put you in a very defensive position. And you know what happens when you are defending? Pretty much you are not scoring. And this is it's a bad analogy, but actually when the teams are on defensive position, they are not going towards actively winning the game. And you know what happened with that? that actually you might have very good defensive position, but actually also is not making move your team in the positions in the championship. In these terms, it means actually you say, well, we are risk averse, don't expect growth then. So you don't have the predictability of growth. You pretty much are stalling, right? But every company have their own philosophy. They have their own risk appetite, their own risk assessment. But if you go with this kind of underneath um, circumstances to an organization, they will feel that actually say probably you are too scared to do things. So how predictable is this going to be if you are in a position of defending yourself all the time because there are too many external risks? And guess what? We live in a world where externally is our playground. So external from our organization is everything is happening. And yes, we have things that we cannot control. Look what happened in Q1 with this conflict in the Middle East. That is completely external to us. Though doesn't mean that actually you don't have certain or other areas that you can control and continue producing business or your output without much exchange with those external geopolitical situations. But you have to be prepared for that. And that is where you control risks. You cannot manage, you cannot eradicate risk, but you can control it. So what does a board do when ambition is not enough? And this is about ambition. In other words, imagine a capital is like oxygen in a mountain. If your lungs are weak, more air does not make you climb easier, right? It only shows how unready you are, right? So even if you get the capital and you are ready for it, you are not fit enough to get that infusion of capital, right? Anyway, so as a board advisor, what I would propose to consider is the following. The first thing is stop treating forecasting as a theater, right? And this is about this ambition, the external factors and the fears. So revenue should align with the sales cycle reality, the margin with delivery reality, and cash with the timing reality. So if a customer slips by 1 quarter, your plans should still stand up, right? So this is back to the things as external uncertainties or external factors. Revenue should align with the sales cycle margins and cash timing, right? So how fast you collect. So that start to build the predictability that you're looking for. External factor, yes, but if you have this focus in these controls, then that external factors start to be less scary or less risky because you have certain things that you can control and you can dictate how you want to go about. The second thing I will advise in these cases is use the asset lens for this stage. In terms of assets, I mean revenue assets. So revenue means repeatable demand and not heroic selling. And I had this phrase that somebody put in LinkedIn the other day, which is revenue is vanity, but profitability is sanity. So, but revenue means repeatable demand. So you have this recurrent income from the different demands that you're creating in your environment. And in terms of the assets, I mean the systems. What are the contracts, the data, the customer quality, and the delivery engine that make revenue dependable. So your assets and your revenues are working together at the same time. And the third thing I would say is show the boards, your executive teams, or you as a founder, which is a logic in plain English. So ask this question: what is the logic here? What has to go right? What right might look like, or what might go late? And what happens if hiring costs more than actually the benefits they are bringing because of the onboarding, the run up, etc., etc.? What happens if sales land more slowly? So investors do not need a fairy tale. They are rational people. They understand business. They need a management team that can see around corners, right? So, as I mentioned, I make all this dark story about external factors, etc. But there are very clear paths how to address them, and very easy. Easy in brackets because nothing is easy in business, but it's doable. That's what I mean. And here's a harder question, if you may. If the market is selective and your board, your executive team, or you as a founder are under pressure, which is usually the case, how do you improve predictability without slowing the company to a crawl, right? So you don't want to be predictable in a way that actually start to slow everything down. So that's what I enter in the picture. And what do you gain working with me? It's pretty much three outcomes: business outcomes, differentiators, and risk reductions. In terms of outcomes, I help boards to turn, or the executive teams or the founders, to turn growth into something the market can trust. So that means clear milestones, better capital timing, sharper risk ownership, and a funding story backed by operating trust. Now, in terms of differentiator, I do not offer a single fixed answer. I assemble a rotating international advisory board around the exact milestone in front of the business, whether the issue is revenue quality, capital design, board reporting, or commercial discipline. And in terms of risk reduction, this cuts a common board or executive teams or founders' mistakes. Hiring one senior person too early and hoping they solve a cross-functional problem. And you see in this graph that we have in front of us, one person cannot manage everything. I cannot manage absolutely everything there. So we need a team, an advisory team that actually doesn't step in your toes, that is not a part of your, it doesn't dilute your shares, etc., but actually can help you and bring all this expertise and specialty capability at the point of need. Then change the mix as a company moves. Because if the problem is here, for example, in terms of capital growth, this team 6 months down the line probably will not the best team for your systems or your edge or your scaling. So we change the team members of the advisory board as we need the expertise where we need the project to go next. So one action you can take today, and it's doable in 30 minutes or less. Take your next 12 months plan and run one simple stress test. What happens to cash, margin, and convenience headroom if revenues lands 90 days late, right? Stress test that. So actually, we are the example that I put last week. This company has 1.2 million in receivables, and they couldn't collect in the 9 months. So it's not 90 days, 9 months. That's more than 180 days, right? So what happened with your organization when that happens? So let's pause here for today and reconvene tomorrow, because tomorrow I will go further with the part that most boards, executive teams, and founders leave too late: the systems and controls that decide whether growth stays investable or starts to crack. Now, if you're interested, let's have a 30-minute call and I can understand your position, where you are, what you're looking for, and how an international advisory board can help you and your organization. So you get a milestone match international advisory boards, so clear predictability, and specialists that support without being with a big consulting overhead or the talent locked in, right? So have a great day and I'll see you tomorrow. Bye-bye.